Today, we're diving into an analyst report on Fauji Fertilizer Company, FFC, one of the real heavyweights in Pakistan. We're going to break down the three main reasons analysts are so optimistic about its future. So let's jump right in.
Right out of the gate, the report doesn't mince words. It's a strong buy on FFC. The analysts are putting a target price of 621 Pakistani rupees per share on it. Now, that's based on what they call a sum of the parts valuation, which really just means they valued each piece of the company on its own and added it all up. That number suggests there's some serious room to grow. So what's behind all this optimism?
Well, here's the headline number that gets everyone's attention, a potential 36% total return. Now, that isn't just the stock price going up. It's a combination of two things: the capital upside, which is the profit from the share price increase, plus the very attractive dividend payments you'd collect along the way. I mean, with a number like 36%, you've got to ask what's going on under the hood.
All right, so where does all this confidence come from? Well, it all starts with FFC's current financial strength. You can't build a great future without a solid foundation, and right now, FFC's foundation looks rock solid.
And what's really interesting here is that FFC's success isn't just about selling fertilizer. A huge chunk of their profit actually comes from dividends. See, they've made some really smart investments in other companies, and that creates this awesome steady stream of cash coming in from the side. And we're not talking about pocket change here. Just in the first 9 months of the year, FFC raked in 20.8 billion Pakistani rupees from these investments. Think of it like a huge financial cushion. It protects them if their main business has a slow quarter, and it's what helps them pay out those generous dividends to their own investors.
And this isn't just a flash in the pan. Analysts are projecting a really nice steady climb in FFC's profits. They see it going from around 79 billion rupees all the way up to over 93 billion in just a couple of years. That's the kind of sustainable upward trend you love to see.
On top of all that, the company is just swimming in cash. With a net cash position of 69 rupees for every single share, FFC has a ton of flexibility. This means they've got the money to fund new projects, handle any economic bumps in the road, or jump on new opportunities without having to borrow a dime.
Now, with a financial base this strong, you might think FFC would just sit back and relax. But nope, they are actively chasing some massive projects that could completely reshape how they operate and how much money they make in the future.
First up is the Thar coal gasification project. This thing could be an absolute game changer. The big idea is to use local coal to create the gas they need to make fertilizer. If they pull this off, it would give them a cheaper, more reliable supply of their main ingredient, letting them make urea so competitively that they could even start selling it overseas. And that's not all. There's another big move in the works: a plan to get a new supply of cheap natural gas piped in from the Mari gas field straight to one of their main plants. This would lock in a consistent supply and slash their costs, which goes straight to the bottom line: bigger profit margins. Okay, so we've got solid profits and exciting growth projects. But here's where the story gets really unique. FFC is making a very strategic, very deliberate push to become fully Shariah compliant. And this could open the door to a whole new world of investors. So what exactly does Shariah compliant mean? Well, in simple terms, it's about making sure a company's money matters, things like its investments, its debt, all line up with Islamic principles. For a huge group of investors, this isn't just a preference, it's a requirement. If a stock isn't compliant, they simply can't invest. And this isn't just talk. FFC is making real, measurable progress. You can see right here in the numbers. They're heading in exactly the right direction. The amount of non-compliant investments they hold is dropping, and so is the income they get from those sources. They are systematically cleaning house. This chart really puts it into perspective, right? That slice of non-compliant assets has shrunk all the way down to just over 31%. That's a huge drop from over 41% just a few months ago. They are clearly on the right path. So why is this so important? What's the big prize at the end? The prize is access to 218 billion Pakistani rupees. That's the total amount of money sitting in Islamic mutual funds in Pakistan right now. Once FFC gets that final stamp of approval, that massive pool of capital can suddenly invest in the company. Think about it. A whole new wave of demand for the stock could be unlocked, bringing in stable, long-term investors. All right, but let's be real. No investment is a sure thing. So for a truly complete picture, we have to talk about the potential risks, the bumps in the road that FFC might face, according to the analysts. So what are the big ones to watch out for?
Well, if the price of their raw materials like phosphoric acid suddenly spikes, that would squeeze their profits. Same goes for their gas supply. If it gets cut or the price goes up, that hits their costs directly. And of course, if farmers have a bad year because of the weather, they'll buy less fertilizer. Finally, you always have to keep an eye on government regulations, which can change without warning. These are all real factors to weigh. So let's put it all together. You've got a company with a super profitable core business. You've got 2 huge growth projects that could slash their costs. And you've got this really smart move towards Shariah compliance that could bring in a flood of new investment. The question for the market is, has all this good news already been priced into the stock? We'll definitely be keeping an eye on this one to see how it all plays out. Thanks for joining me.